Saturday, July 15th, 2023, Maneco 64, home of alternative economics and contrarian views. We're going to look at the Bank of England and why I think that the Bank of England will not be able to avert a major confidence crisis. And I think interest rates are going to soar to unimaginable levels. Yes, I've said that a few times in the last month or 6 weeks. And actually, I'm going to reference The Price of Time by Edward Chancellor, a book that was published last year, and I've started reading it, and I've already found some really interesting parallels with what historical figures said about interest rates and economic cycles. And I think everything's pointing, unfortunately, to the Bank of England not having acted promptly to nip inflation in the bud. And one of the reasons I'm looking into this topic is not that I want to be negative or anything. It's all about what's happened over the last 15 years or so, ever since the 08 crisis. Aside from being behind the curve, the Bank of England actually encouraged all the malinvestments. And I think real estate, residential real estate, or property investment is one of the big bubbles that could really create a major crisis of huge proportions in this country. I've been reading this morning in the FT, also in the Times, about the shock that people are getting, not just people maybe on more modest incomes that have taken on a lot of debt to buy a house, but also the wealthy, the people who probably didn't really need to borrow. They could have been less greedy and bought something for less and not taken on such a big mortgage. There's even examples of people that, aside from buying their own residences, they bought other properties to invest in. They've taken huge interest-only mortgages, and it has a big impact when interest rates rise quickly. It affects them even more, their cash flow. And I just wanted to give you an anecdote or a story from when I worked in the markets, in the futures market in London. There used to be a local. A local is someone who trades for his or her own account in the exchange, in the pit. Of course, there is no pit anymore. It's all done electronically. But he was called Terry Crawley. He was like a legend. The story was that he came from humble background, that he was a carpet fitter, and that he was doing some work at the London Futures Exchange, and he asked someone, what are these people doing? And someone told him that they made a lot of money, and said, well, I can do that. And he became very famous. He became the biggest trader in Italian government bond futures. And there's a story that I heard, and many people heard, that he was in the pit and two other traders were talking about mortgages and buying a house. And they asked Terry, what do you think of this mortgage? And apparently what he said is the following: what the F is a mortgage, right? So what's the moral of the story here? Well, I think Terry Crawley was right. If you're wealthy enough, if you have enough money and you have a good income, why take on a huge mortgage? Why even take a mortgage if you can buy a place outright? I know that's not the philosophy of a lot of people like Kiyosaki and others, but not everyone can be a property mogul, especially if you're doing a completely different job. And I think this is what's happening. And it's going to be, I don't know how it's going to be, but it doesn't look good. So in this story here in the Times, it says the interest-only mortgage shock. Hundreds of thousands of homeowners use these loans to cut costs. Now their payments could double, well, and they could triple as well. And this article is from June 18th, so about a month ago. And it says the average 2-year mortgage rate is now 598, and the average 5-year rate is now 562. Well, these have gone up, of course. I think now the 2-year rate is more like above 6, and the 5-year rate is approaching 6. So it's all changing very quickly. One interesting thing that I saw here was this comment from someone who taken on interest-only mortgage, and her payments have gone from $1,500 a month to $2,900 a month, and they can still cope. And I think this is important here because we have the Bank of England to blame for this. And she said, Beverly, 37, we have only ever known low rates. So there you go. And I think that's been the philosophy and the strategy in the last 5-10 years. People never thought that rates would rise as quickly as they have. And why? Well, because the whole economic class, economists in the City of London and finance, the mortgage industry, they seem to think that the Bank of England had their back, that they could keep inflation under control, and that rates would be at 1 or 2 or 0 forever. And that's something that I have been warning for many years, of course. So that's why I think we could be in for a major crisis. And a lot of these people who've taken on huge mortgages, they're high flyers. And I think they have a lot of discretionary power, spending power. And we could see that reverse massively. So I'm going to put these articles below in the description. There's another article here in the FT. Wealthy UK borrowers face interest-only mortgage payment shock. And the other thing about these interest-only mortgages is that the philosophy here, the strategy, is that property prices will always go up, and that people's income will always go up, their investments will always go up, and that eventually they can just sell the property and pay off the mortgage and take the balance and buy something smaller or buy fewer properties, because a lot of these people, they're buying other properties as well. I mean, they're so greedy, and I'm afraid this could end in tears, because we could see a complete reversal of everything. And here's where we come to what I think is going to be a crisis of confidence, and you'll see what happened. So on page 64 is a chapter on John Bull cannot stand 2%. And this is what the author writes here. As the cycle entered its final stage, the Bank of England would be forced to raise rates. The important thing, said Bagehot, that's Walter Bagehot, was that it should act promptly. Bad lending had to be nipped in the bud. The best method, the sole method to contract the entire credit currency in this or any other country is to raise the rate of interest. If the bank failed to act in a timely fashion, a crisis became inevitable. During a panic, trust evaporates and interest rates soar. After a prolonged period of high rates, however, business is checked, prices fall, the exchanges are righted, and the balance of trade redressed. Once the panic has passed, capital lies idle and savings accumulate, and the supply of loanable capital exceeding demand for loans brings the rate of interest to a low point. So that was Walter Bagehot, a famous writer, economist in the mid-1800s. And he came from a family of bankers, so he had kind of banking in his blood, and he was actually the editor for The Economist, I think. Walter Badgett. He's the guy who also said that when there's a bank panic that the central bank has to lend abundantly, but against good assets. Not that I agree with having central banks, but that's what he said anyway. And the other individual that I'm going to quote is John Locke, because he had a lot to say about interest rates. And this is in the chapter about the lowering of interest. This is on page 43. This is what the author says. Locke was the first writer to consider at length the potential damage produced by taking interest rates below their natural level. It's worth summarizing his position in modern language. In his considerations, Locke suggested the following undesirable outcomes that might occur. So we'll go through these. Financiers would benefit at the expense of widows and orphans. Well, there you go. That's the hedge fund guys, the private equity guys, the bankers. Wealth would be redistributed from savers to borrowers. Well, there you go. A lot of people out there who have these interest-only mortgages, they think they're worth X, but I think they're going to be in for a shock, to be honest. Creditors would be inadequately compensated for risk, definitely. Bankers would hoard money rather than lend it out. As the velocity of money circulation declined, prices would fall, deflation. We haven't really seen that much, but let's continue. There's some more stuff here on the list. Too much borrowing would take place, definitely. Money would flow abroad in search of higher returns. Asset price inflation would make the rich richer. Well, yeah, you've heard of the 1% or even the 0.01%. You heard of what happened in 2020-21 when they cut rates to zero and they did trillions of QE, how many new billionaires were created. The reduction of interest rates wouldn't revive a moribund economy. Well, you just have to look at Japan. So this is what the author says about Locke's list here of the ills of artificially imposed interest rates, which we had until recently from 2008 up until, early 2022. In short, Locke argued that a forced reduction in interest rates imparts no benefit to a society lacking in industry and frugality. Such views on interest hold little sway in the modern world. In the wake of the global financial crisis of 2008, central bankers slashed interest rates, hoping to revive economies by easing the burden of debt and boosting asset values. Their aims were remarkably similar to those espoused by the 17th century advocates of easy money. Some policymakers even shared Josiah Child's extraordinary belief that raising asset values by lowering the rate of interest was akin to creating real wealth. Well, they call it the wealth effect these days, don't they? People like Bernanke and Janet Yellen or Alan Greenspan. After a decade and more of unconventional monetary policies, it appears that Locke was prescient. As we describe in later chapters, the central banker's policy of ultra-low interest rates hurt savers, widows, and orphans, while benefiting financiers and senior executives who reaped windfall gains after the cost of borrowing fell below corporate profitability. Paper wealth has multiplied while genuine wealth has stagnated. I'm going to stop here. Paper wealth, right, has multiplied and real wealth has stagnated. And that's why I'm sticking to my long-term plan of holding on to real wealth like gold and silver, or even property, unencumbered property, of course, without a mortgage, or anything that's bolted to the ground, anything that's solid, anything that's real, land, farmland. And that's why maybe Bill Gates is buying farmland, aside from his other nefarious goals. But yes, so I personally think that we need to be very cautious. And if any of you have big mortgages or interest-only mortgages that are coming up for renewal, I'm not giving advice here, but all I'm saying is that things are going to get much more difficult, because I think interest rates are going to go a lot higher than people expect. And if there is a crisis of confidence, you could see rates into the high teens, or even into the 20% area. We saw that happen in Greece about 12 years ago during the sovereign debt crisis in the Mediterranean part of Europe. I think Greek 10-year yield went up to 40%. I'm not saying rates are going to go to 40%, but I think Walter Bagehot had it right, and so did John Locke. and the central bankers have, especially the Bank of England, but also the Fed and others, aside from not nipping the inflation in the bud, they kept interest rates artificially low by doing their QE for too long. So I don't even think that Walter Bagehot would have imagined that they would have done that kind of QE, let alone not nip inflationary pressures in the bud. So that's why I think things are going to get a lot worse. I'm not sure how they will evolve and how long it will take, but batten down the hatches, I would say, and hold on to your real wealth. And with that, I'm going to wish you all a very good weekend. Take care. Bye.